So at this time, I would like to invite our presenting authors, our academic moderator, and our community bank discussant to come to the front of the room for research paper session 3. This is our third and final research session of the 2024 conference. The title is Consumer Protection. Our academic moderator is Ann Beatty. She's the Deloitte & Touche Chair of Accounting at The Ohio State University's Fisher College of Business. Our presenting authors today, Cathy Zhang from the University of Florida, Anya Klemenova from the Board of Governors of the Federal Reserve System, and Giseli Cespedes from the University of Minnesota. Our community bank discussant is Orv Kimbrough, who is the chairman and CEO of Midwest Bank Center here in St. Louis, Missouri. So welcome to all of you, and Ann, I'm going to turn it over to you.
Great. I think we have a wonderful, interesting panel for today, and we are largely going to follow the exact same format as you saw yesterday, with the slight variation that I thought it was a win-win if you got 5 more minutes of Orv and 5 less minutes of me. Hopefully that. So we're splitting the time just slightly differently than before, but we will just proceed with our authors through the program. So Cathy.
Good morning, everyone. Thank you very much for having me here to present Do Financial Consumers Discipline Bad Lenders? The Role of Disclosure Awareness. This is joint work with Mark Flannery and Philip Wang. So by the way, all of us are from the Gator Nation, so I was kind of hesitating to put up some Gators because this is the official template. Okay, so as we know, the banking regulations in the U.S. have 2 primary regulatory missions. The first is, of course, safety and soundness of financial institutions, and the second is financial consumer protection. So market discipline has long been viewed as complements to formal supervision, while a large body of prior research or literature has been focusing on whether market disciplines banks for excessive risk-taking. Limited research or little has been done to examine whether market disciplines bad lenders for taking advantage of financial consumers. This is definitely a very important question because the 2008 financial crisis has already demonstrated to us that regulatory oversight alone did not do a great job in preventing predatory lending. And also, recent studies also show that predatory lending still persists even in today's mortgage market. So in our paper, we examine 2 important research questions that are related to the 2 dimensions of market discipline framework. So the first question is related to the dimension of market monitoring. Specifically, we're asking, do financial consumers penalize bad lenders for engaging in unscrupulous lending practices? And the second question is related to the dimension of market influence. So if they do discipline, how would lenders change their behavior in response? In order to answer these 2 questions, we focus on a unique setting of enforcement actions by the CFPB and the state regulators that specifically target on the illegal lending practices, such as deceptive advertising, overcharging borrowers, or using tactics to intentionally mislead the borrowers. So pretty bad. So the enforcement actions have not been previously studied, but they serve, of course, as the most credible signals of unscrupulous lending practices. Okay, so all of these enforcement actions I was just talking about are easily accessible to all of the consumers via this regulatory website called Consumer Access. So basically, if you want to find out about these enforcement actions, they're up there. They are publicly disclosed. Okay, so in terms of data, our sample period is 9 years from 2011 to 2019. We collect the enforcement actions and the lender's alternative names from the Consumer Access website I just talked about, facilitated by NMLS, National Mortgage Licensing System. The loan application data is from the HMDA dataset, and we also use the GSEs and Ginnie Mae dataset to collect loan-level interest rates and borrower characteristics such as their FICO and LTV. We got the complaint database from the CFPB website, and we specifically focus on the mortgage-related complaints to be clean. And we got media coverage of all these enforcement actions from Factiva. And lastly, we used the ACS survey by the census for local controls. Okay, so this is an example that can help us to visualize what an enforcement action looks like. So this is again from the Consumer Access website. This is LYC Mortgage. So as we can see from at the bottom of this web page, here we have a list of regulatory actions taken by the state regulators in Connecticut and Texas. So again, this is all public record. And if you want to find out, they're just up there. So basically, it seems that consumers have no reason not to react to these enforcement actions. Okay, so getting back to the market discipline, well, the market discipline actually works pretty well in capital markets, where the investors can simply sell shares or require higher cost of capital. So if that's the case, we should observe price drop. And we did observe price drop in related markets. Similarly, in financial consumer markets, consumers could do something similar, right? So they could simply stay away from the bad lenders. If that's the case, we should observe fewer loan applications submitted to these lenders. Or they could require better loan terms. And if that's true, we should observe lower interest rates. So let's move on to see what's happening in reality. Actually, what we find is that borrowers on average do not reduce loan applications to the sanctioned lenders, and in the meantime, they do not get lower interest rates. So just to summarize here, it seems that borrowers on average do not do anything, or borrower inaction. And this borrower inaction is so weird, and it's in contrast. It's definitely in contrast with the prior literature on enforcements that consistently show that enforcement actions should elicit significantly negative market reactions across many other contexts, such as accounting frauds or banks' unsafe and unsound lending practices. So it also challenges the practitioner's claim that financial consumers are taking good care of themselves and they could even deter unscrupulous lending. That's not what we find. And lastly, and most importantly, this borrower inaction implies that the regulators who have good intention, who aim to help the consumers with all sorts of disclosure of the enforcement actions, did not really achieve their goal at the end of the day. Okay, so next we're gonna explore why borrower inaction, or in other words, why do they not react to these enforcement actions? And here we propose three explanations: borrower unsophistication, lack of lender choices, or disclosure unawareness. So to examine the role of borrower unsophistication, we partition our entire sample into terciles based on the borrower's education. And surprisingly, we find that even the most educated borrowers do not react to the enforcement actions. In other words, even in the post periods, we find that even the most educated borrowers do not reduce loan applications or require lower interest rates to the bad lenders. So it seems that this first explanation, borrower unsophistication, is not the driver for borrower inaction. Next, we're going to move on to see whether this borrower inaction is due to lack of lender choices. This could happen when like a few borrowers other than the bad ones are available to the borrower's areas, or it could be the case like the bad lenders primarily serve the risky borrowers whose applications would not be accepted anywhere else. So in other words, lack of lender choices. This is also not what we find here. So basically, we find even borrowers in areas with most lenders available to them do not react. And we find that even the least risky borrowers, or in other words, the safest borrowers who never lack lender choices, do not react to the enforcement actions. So again, this explanation, lack of lender choices, is not like the driver of borrower inaction. And lastly, we're left with this disclosure unawareness. So in other words, it could be the case that they simply don't know, even if the enforcement actions are publicly disclosed. So the intuition here is that probably when they really know, or when they learn about those enforcement actions from media coverage, when they really know, they would react. And indeed, we find the results here. So we find that borrowers do react to the enforcement actions only with high media coverage. So basically when they know, they react. So conditional on this high media coverage, we find that the loan applications to the bad lenders dropped by almost 19%, and interest rates decreased by almost 6 basis points. So pretty big drops. And in contrast, for enforcements with low or no media coverage, there's no reaction at all. Okay, so next we're gonna move on to the second dimension of the market discipline framework. So here we're checking whether the sanctioned lenders subsequently change their behavior. And specifically, we want to find out whether the sanctioned lenders subsequently improve their service quality and whether they attempt to hide their identities by adopting more alternative names. Okay, so yes, indeed, we find some results here. We find that the disciplined lenders whose enforcement actions received high media coverage, they did change their behavior subsequently. They improved their service quality. The evidence is that the subsequent complaints dropped by 9.5%. In contrast, we do not find any effect for the enforcements with low or no media coverage. And very interestingly, we find that the lenders who escaped the market discipline because their enforcements were not covered by high media coverage. So basically, the enforcements with low or no media coverage, these lenders adopted significantly more alternative names subsequently, more doing business as. And again, in contrast, we find the disciplined lenders whose enforcement actions with high media coverage, nothing changed. It seems that they have nowhere to hide. Okay, so specifically, I want to talk about banks versus non-banks. So it's important to notice that in our study, the lenders include both banks and non-banks. And if we partition our lenders into the groups of banks and non-banks and rerun all the analysis, we'll find something really counterintuitive here. Specifically, we find that borrowers react to the sanctioned banks, but not to the sanctioned non-banks. And consistently, we find that the sanctioned banks improve service quality, but the sanctioned non-banks do not. It looks really weird, right? But why is that? Well, the reason is only because the bank's enforcement actions receive significantly more media coverage compared with the non-banks. And if we focus on the bank's enforcements that receive low or no media coverage, there's no effect. We don't find any reactions or subsequent improvements. So again, the key point here is still all about the media coverage-induced borrower awareness. So it gets back to the awareness, not about the type of lenders. So I specifically brought this topic, banks versus non-bank, up because many studies in the mortgage lending space, they usually limit their samples to the banks only. And doing so can lead to biased inferences, as I just talked about. And, nowadays, banks only take care of about 1/3 of the mortgage originations in the US, and non-banks are playing the dominating role, taking care of 2/3 of the mortgage originations in the United States. So the picture missing non-banks would definitely be incomplete. That's the message here. Okay, so finally, some policy implications. So it's very important to keep in mind that consumers are more likely to be passive information absorbers rather than active information searchers. And with that said, even the best disclosure or even the most easy to understand disclosures could fail if the consumers are not aware of them. So I think the regulators should take consumer awareness into consideration for future policy making. And lastly, I want to say in recent years, some of the US legislators proposed to roll back the regulation on financial consumer protection regulations. And our finding of the general borrower inaction really raised the question about the financial consumers' ability to take good care of themselves, to protect themselves. So we really call the regulators, do not leave them in the dark, unprotected. So this is all I have. Thank you very much.